Awesome. Welcome everyone to another edition of Into Charts. Very excited to have you all back this week. I think I'm going to start today. That's what the randomizer has told us. So I'm going to share my screen. I'm going to share with you. You guys know I have the spins on investments charts. And I ran across a chart that I think is kind of interesting, but it has a story as to why I'm showing it today. So it is a very common conversation at On Ventures across the table that the question is, we're at an all-time high of prices or prices are going up. Should we buy these tokens or not? And when should we enter the market and how do we do execution when we actually want to enter a liquid position? This is a very common conversation around the table. And primarily, I think we've exhausted all the points, but obviously we have to take information from the market and make the best decisions. So in that context, I saw this chart. This chart is S&P 500 return. It's a total return index, and it's the average forward total returns from September 1989 to November 2025. And it is on the x-axis, the 1 year, the 3 year, and the 5 year forward returns. And it has two bars in each of them, one green, which is if you invest at a new all-time high, what's the percentage of return you will make 1 year, 3 years, and 5 years in the future. And in blue, if you invest in another other time period randomly, what is the return that you'd make in 1 year forward, 3 years forward, and 5 years forward? And essentially, the conclusion that is extremely counterintuitive, but it makes sense after you think about it, is that investing in all-time highs, on average, actually gives you better returns 1 year, 3 years, and 5 years in the future. And so I want to leave that out there. This is extremely counterintuitive. It breaks the buy low, sell high mental model that most people have, right? When you invest in all-time high, you are by definition investing during a strong uptrend. And when you invest at any given day, arbitrarily, you're actually just averaging all these periods of downtrends, bear markets, crashes, et cetera. And so I just want to, we know the explanations, I think, intuitively, and I can go into them for completion, but I just wanted to show you guys this chart and let it sink in because we have this conversation all the time. And the data shows investing at all-time highs is the single best thing we can do. Go.
My brain is broken. I feel like an omelet right now. Like you just cracked the egg. Uh, I'll let Chris bail me out on this one.
I mean, the TLDR is just get involved, right? At the end of the day, all these numbers are positive. And so if you look over some long enough time horizon, the economy grows. Obviously, we all know that. The green bar being bigger than the blue bar is definitely counterintuitive. But my guess, and Diego, you've thought about this more than I have, obviously. So correct me if this differs from your interpretation. Is that I forget who said this, but there's a couple of VCs who said this. Maybe it was Bill Gurley or maybe it was Peter Fenton. Is somebody at Benchmark basically said the reason why you can't pull out of a market when you fear that there is a bubble happening is that basically the majority of returns actually happen towards the end of a bubble. And maybe this is kind of what that is referring to, which is these periods of irrationality, so to speak, end up actually generating more returns than if you were to invest and get involved when things are relatively not volatile and kind of stable and almost quiet. Um, and so this to me is kind of a almost a reflection of the volatility more so than obviously what you would want to do is if you can actually pick the times, then you'd want to buy low and sell high. But if you kind of admit that nobody really knows how to predict macro, then, if you actually don't invest fearing it's a bubble and then you miss the best 5 years of that, then actually your returns are going to look terrible relative to your peers. That's one interpretation.
Yeah, I mean that resonates. Like you'd have to believe that this type of chart follows like a heavy tail skew, where the most violent all-time highs at the end where it goes up a lot, and there's actually a lot of time where the all-time highs are not that high, such that you're averaging out buying on the way up and then it goes like really high up at the very end. But when I think of the S&P, I think of it as more steady Eddie. And so we don't need to explain to Breck why this chart makes sense, but I'm still not sure I fully understand it. It's definitely counterintuitive, but it's
Yeah,
cool.
it's counterintuitive. Yeah, it's counterintuitive. But I think, I think Chris is correct, but Chris is actually talking about one specific instantiation of actually a very known phenomenon in markets, and it's effectively momentum. So think about it as the trend is your friend. In stock markets, specifically the highs, they tend to cluster. A new high actually is very seldom an isolated event. It's usually followed by another high. In fact, since 1950, I think the stat is roughly 7% of all trading days have been new all-time highs, right? So on average, there's a new all-time high every 2 weeks. And so if you want to summarize the trend in the conclusion is like, look, the key takeaway is if you refuse to invest at all-time highs, you invariably are sitting out of the market during its strongest momentum phases. And so you are actually missing out the majority of the growth or a big portion of the growth. That is the rough mental model. But it does not have to do with bubbles necessarily. Bubbles are an extreme outlier example of the general rule, which I'm sure is part of the reason why it showcases on the averages themselves. But that's just it's just the reality, right? And so that's why it's so counterintuitive. And another way to think about this is um, time in market. Turns out that like if you wait, the aspect of not waiting for not an all-time high, in waiting longer to actually enter the market, it's not showcasing these graphs, but that is the second problem of the mental model that people avoid is by avoiding the all-time high, you're just losing time in market too. When time in market is another one factor that is actually correlated with higher performance over time. So not time the market, time in market, as people say. So these are the two biggest like contributors usually to underperformance when you try to time it, when you try to catch the lows, when you try to say, hey, it's all time high, we're not going to invest. So I really wanted to bring this because yesterday we were having this conversation. Is a very common topic of conversation. And I love that the reaction from Beck was like, this broke my brain because this is exactly what I wanted to do.
I'm gonna have a long conversation with ChatGPT Pro to understand this chart. I'm
Just
gonna
in
have a
time for 5.2, right? They just launched 5.2, so just in
that's
time for
that's right. That's right. This
awesome.
is awesome.
This is a great
Cool.
chart. All right,
Amazing. Let's go.
I'm up next. I actually brought three, and I'm gonna do it in the.
Oh
I'm
Lord.
actually just gonna flash the article because it's more dynamic charts. Can you guys see this? Perfect. I'm actually gonna scroll up. Sorry.
Yes, we
Okay,
can.
so this is a Crunchbase article that was published in Q2, which summarizes venture dollar funding volume over the last 2 years. You can see by quarter, and it ends in Q2 2025. The different colors here represent the different stages. And I can't quite explain to you what technology growth means, but it's a really tiny part of the chart, so I'm just going to ignore it for now. But you've got here in the light kind of gray purple color angel slash seed, early stage, late stage, and then I don't know what this is, but technology growth. And clearly, one thing that you can see here is that at least in North America, venture funding has absolutely rebounded from the lows of 2023. So you can see here, this is 2023, it's rebounded, and then it started to really explode in Q4 of last year. And the other thing that you'll notice here is just how much of the dollars have gone into the late stage opportunities. So obviously, you can see here early stage is hovering around 14.6, hovering around the like early teens, hop to 22.6. But then you can see here in the last 4 quarters, it's just been hovering around 14. So early stage has been pretty consistent in terms of dollar volume, but growth stage capital has really exploded onto the scene. Um, I want to show you the other two charts, which is the same chart but for Asia, and you can see here that the dollar volume of investments have actually gone down. You might call it like flat to down, but it's generally on a downward trend. And then obviously here, the proportion of early stage to late stage is much more consistent, and it's actually closer to almost being equal. And then lastly, I'll show you Europe, which has just basically been flat. And then a similar dynamic, if anything here, the early stage kind of outpaces the later stage. So I wanted to show you guys these three charts.
Chris,
I
I
have more
thought
that I can say here, but
Europe bashing was exclusive for me. I don't think you can Europe bash if you're not from Europe. I'm just saying.
I'm not bashing Europe. I'm just saying they're consistent. Just saying they're consistent. So I'll pause here. I've got other thoughts, but I don't want to steal all the insights. So whatever you guys have reactions to on this, feel free to go for it.
I mean, man, um, I think my initial thought on the North America venture volume chart here is the purple is the thing that steals the show. And, there's a lot of commentary online about how the IPO markets are screwed up and how private markets are taking all the dollars, and a lot of the returns that used to be in the public market are now being internalized by these large mega funds. And that's kind of where my mind goes, is like a lot. I would be willing to bet as well that of Q1 there's probably like maybe a handful of companies that took most of those dollars. It's like the open AIs, the Anthropics, you could go down the line, and that's where my mind initially goes.
Can I ask a clarifying question? Do you think this is dollars in as kind of like new primary rounds? Basically, the thought is the following: things are not IPOing, things are staying private longer. So there's a lot of
Exactly.
like trading hands. And so if it's total volume, the private markets are now much, much
Mm,
larger than we've ever were before. And that would sort of show up as like new investments, but it's actually investors trading deals. There's not like new net money raised from LPs entering the market. It's basically these things like it's volume, right? So it's things trading back and forth from different portfolios. That was actually one of the questions that I had in terms of like, is that the phenomenon that I'm seeing? Because that phenomenon seems intuitively true.
That's a good question. I don't know. They didn't really share much about the methodology of this stuff, but I actually hadn't thought of that angle. But certainly we see that in the market a lot more where companies do stay private for longer. If anything, the secondary markets for some of these later stage growth companies have almost become institutionalized, right? Like they've got like
totally.
quarterly liquidity events. And so it doesn't really feel that different than receiving an RSU from Meta or something if you work there, right? So you
There's
got
also
these
a lot of
quarterly
games
liquidity
being
events.
played. Definitely a
Yeah,
lot of games being played around multiple term sheets with different valuations simultaneously. There's games being played of financing rounds in which secondary and or is being like gobbled up into the actual total amount fundraised. You raised $1 billion was actually $100 million of preferred, $900 million of current investor sales, and there's lots of games being played here, which obviously factor to the highlights of these. But I think the
yeah,
bigger phenomenon, if I had to guess, is what Breck pointed out, which is these massive, massive companies going closer to $1 trillion valuations, like being injected hundreds of billions of dollars of new capital dollars. That's just like AI has saved the U.S. economy and has saved venture capital.
yeah. So I was thinking about so I actually hadn't thought of that angle, so I'm glad you brought it up. The others that I was thinking about was when I look at the purple chart, I immediately think, okay, that's like OpenAI raising another $1 trillion. It's the AI companies, right? And um what's interesting is that if you zoom out even further, the AI narrative is really almost pitted as like, well, we're competing with China for AI dominance. And obviously, China has taken a different route where they're trying to do more with less, right? And that's been talked about quite a bit too. And so when I saw the Asia venture dollar volume, I mean, you have to believe that most of this is in China, right? Like Korea doesn't have that much venture dollars going into it. There's some, not a ton. Japan, like not a ton. Southeast Asia, there's some, but I'm sure China is a bulk of this. And you're not seeing like these massive later stage dollars pouring into it. And early stage is still, pretty consistent and healthy. So that was one thought that I had, which was maybe it's the likes of these AI labs raising a lot of money. And if you look at the China venture dollar volume, it speaks a different story. The second thing that I was thinking about was the other thing that's very hot right now are very physical businesses, either in defense or building out data centers, et cetera. And historically, even 10 years ago, if you were to go into a venture firm and pitch a hardware startup, they'd be like, hey, that's just not our focus. Like, we don't do that. Today, I think you would go in there and they get really excited about it, depending on which firm you pitch. And so the venture has come back to some of these very capital intensive businesses that require a lot of capital to hit escape velocity. So you can see here, like, $2.5 billion Series G for Anduril is just one of these examples. But you got new chip makers, you've got people making like defense tech, you've got people making, reactors, you got all this physical stuff that I don't think you would have really seen on the venture stage, call it 10 years ago. So that was the other thing that was going through my mind. And I think a lot of that's happening in the US.
Completely agree. Completely
Yeah.
agree.
So,
It's a cool
Do
one.
we
all right.
do we want to talk shit about Europe real quick? So Diogo has his piece
No,
before
no, no,
we
no,
move
no, no.
on.
I'm on a European uptrend.
Europe has great culture.
Yeah.
Okay.
It's a
I
great
think
culture
that
carrier.
I think that means I'm next. So
You're next.
we're gonna take things a slightly different route. In the last couple of podcasts, we've talked about how prediction markets are kind of like blurring the lines between finance and entertainment. And earlier this week, we had some pretty big entertainment news, so I thought we should talk about it. Um, so Netflix put in a bid to acquire um, Warner Bros. Discovery for $72 billion of equity value, basically to acquire HBO Max and all of their content. Um, in the meantime, actually been a hostile bid by Paramount to try and acquire it for more. I actually don't know where that has landed, and I'm sure it'll take a little bit to um, fall through the cracks. But let's
Last I
assume for
checked,
this.
by the way, the board had not answered. Just simply had not answered to the bid. It was the last I checked. That was which is hilarious.
Well, because Paramount originally underbid, they wanted to buy the whole thing, and now we're upping the bid. Yeah, I mean, we don't need to go into the details of some of the drama there, but let's operate under the assumption that Netflix is acquiring Warner Bros. And what that means, because I think it's kind of interesting. So I found this chart that someone online had taken a slide from Andreessen Horowitz and changed it to show what Netflix would look like if they had all the viewership of HBO Max. And it tells a pretty crazy story. So right now, YouTube is dominant in terms of mindshare for streaming. And I have to imagine that's a mix of both YouTube.com and YouTube TV, where they're doing both like user generated content on one end, and then also like now they're doing straight like effectively cable television on the other. And then the rest of it is streaming. It's streaming platforms like Netflix, like Disney, with things like Hulu, Disney Plus, and then obviously now you've got like Paramount Plus and all the large traditional media companies have their new streaming um, apps. But it was striking to me that the two biggest ones stand in complete opposition. So Netflix seems to be playing a game here where they're trying to king make streaming content. Obviously in the last couple of years, they've gotten away from just doing pure play distribution, but also making their own content. And they're now acquiring HBO. Whereas YouTube, so like, let's put Netflix in the middle. And then you've got YouTube on the complete opposite side doing user generated content. They're going to have the most new content every day. And then they're also doing cable television, which is kind of like the stodgy, let's watch live TV, let's watch network television. And it kind of makes up the whole chart. And it feels to me like this is maybe even a more interesting um, potential competitive battle than Uber and Lyft. Like everyone likes to use Uber and Lyft as like the canonical network effects. Um, competition. But the thing is, they kind of have they don't have unique supply. But in this case, Netflix very much has unique supply in their content, and then so does YouTube. And so I feel like we're going to see these two companies battle more and more over the coming years over everyone's attention, um, in a 24-hour cycle. And I don't know. I think it's pretty interesting. So I wanted to open it up to see if you guys had any thoughts here about the acquisition, if this chart was interesting, what you guys thought about it?
One thing that I've been thinking about is Netflix's business model definitely is the winner here. Period. They've won. They've won against like worth more than Comcast or worth more than all of these companies, and so they've clearly won. The business model is really good. I think for the consumer, this isn't being good. The people that are going to be extremely disappointed and are likely very against this are actually the content creators, because Netflix's business model is a model of massive distribution, um, and then they're going to have a lot of pricing power because they're going to be the biggest behemoth by far around content. And you cannot escape Netflix and their dominion when you're a content producer. And then they are known for making cheap movies that are high enough quality to always have something new and fresh because that's the model that they have is on Netflix, you always go and you have something new and fresh to watch, and it's about maximizing the actual hours of consumption of your streaming, which is not the model of a movie theater. And like there's many different models of like of how these other movies and these contents have actually been monetized. Theirs is very specific about getting somebody to spend the most amount of time in front of a screen. And I think the quality of the content is going to suffer. Actually, that is my first thought here. It's like going to suffer a lot more. Like we're about to go into the age of mediocre content because Netflix has so much power and has such a specific model that is working so well that we're going to get more of it. And then you add on to this like AI slop, and then I'm now imagining like Netflix is actually the harbinger
Hmm,
of
interesting.
AI slop to the world. Like they are the distribution channel for this AI slop. It starts by being, get B-listers in the US, and now it's getting like B-listers somewhere random Europe, and then it's about like, put a virtual set behind them, and then it's just like replace them all together. And because that's going to be the thing gets is the first just content. So the AI slop is coming, and Netflix is going to be the distributor of it. Is kind of like my ultimate conclusion here.
But don't you imagine YouTube probably has ambitions of going like it's clearly going both sides and it wants to squeeze out Netflix. Like I could see YouTube saying we're going to play this game as well
Oh,
at some scale
yeah,
because now they're on the TV. They're not just on your iPad and your computer on your phone. They're
Can
now
I ask you
like
one thing? Sarah Tavel from Benchmark had this like unit of consumption, or was it I think it was unit of content or unit of consumption, in which like the form factor ends up winning. There's a new form factor, and new form factors are the things that actually usually win. It's like the disappearing video, it's the picture in the case of Instagram, is the chat, the DM,
yeah,
it's the streaming video. I wonder if YouTube is just not a different like unit of content type. Because what I go to do on YouTube and the frequency, and it just feels
it
like it's
definitely is.
so
Oh,
distinct,
it definitely is. It definitely
and you
is.
can't mix. It doesn't seem like you can
But
mix.
they've
Maybe you
done it
can.
with YouTube TV. Like, right now, I don't have if I watch TV, if I'm watching live sports, if I'm watching reality TV that's live, I'm watching it on YouTube TV. Like,
But
they've
that's interesting because that's
successfully
not what Netflix does. That is not
I
what
know,
Netflix frequency for
I
Netflix
agree.
for.
I totally
This
agree.
This Netflix and chill concept is just like feels like it's a unique like unit of content. It's like a very specific type of thing you're looking for in a very specific time in your day in a very specific moment. And YouTube has never been able to do any of that, not even once for me.
this is where I was gonna go as well, Diogo. So
Mm,
I was thinking about when do I watch YouTube versus when do I watch Netflix, and they're just completely different use cases for me, even though it's like a similar product or similar type of product. Obviously, the content is very different. The mood that I'm in is very different. The amount of time I'm going to dedicate to watching this is very different. So they kind of seem like totally different use cases for me. Uh, and then when I think about the difference between Netflix and HBO, what pops to mind is it's actually a similar type of use case, but very different type of content. So when I think about Netflix, to your point, Diego, it's not like screaming high. It's certainly not indie. It's not like screaming the highest production quality, but it's like the most mainstream possible thing. But it's also
correct.
not terrible. Like it's good. And so actually the
It's
area
like
that I
Uber
believe they're
X.
making but yeah, the area I think that they're making the most amount of money is actually creating content out of Korea because it's much cheaper to make there and then distributing it all around the world and getting US subscribers to pay whatever 15 bucks a month for it. And that's the arb that they're playing. And actually, I think the thing that they've been brilliant at is taking content from all over the world and distributing it to all over the world. Like before Netflix, you would never have watched a show from Korea unless you were, like somebody that was really into that niche for whatever reason. And so I think they've been very good at that. And what I wonder is, are they saying, okay, we've dominated this niche, and now it's time for us to go and get other types of content? Because I think Netflix has tapped out on its subscriber growth. And so maybe they're thinking, okay, we need to branch out into other types of content in order for us to grow our subs more. The extreme end of this like high production quality content is Apple TV, where like you have to be in the mood to be like pensive and reflective in order to watch an Apple TV show. It's like you're not going there to watch like a Marvel movie. It's very different. It feels like it's like very high production quality. And that's what I wonder if that's what's going on is they're seeing their sub growth slow. They're feeling like, okay, we need to branch out into other pieces of content to do so. our brand doesn't reflect that. Maybe our DNA doesn't reflect that, and we got to get something else in here to continue to augment. And they have the distribution to do it, and so maybe they just get leverage on their distribution by doing so.
Yeah, I imagine is like right now, the supplier of content is like a cost of goods sold for them. They're licensing out some IP that Netflix is distributing. And there's definitely like the Netflix pop. Like, do you remember when the assets were listed on Coinbase that would go up like, 4 or 5 times like back in the early days of crypto? Like, there's definitely a version of that for Netflix. And I think the best example is Formula One. Like Formula One, like 5 years ago was a nothing sport. It was very niche. And then like Netflix drops the Formula One Drive to Survive, and now all of a sudden Formula One is massive. They have a huge TV deal, and people that never knew about the sport 5 years ago, like are ride or die fans. There's definitely a component of that that's happening. And if you look at, there's a really good Nielsen has this like uh top 10 chart. If you look at what's being watched right now, what's the top 10? Six of them are Netflix original shows, which is actually really interesting. So there's like they have this like vice grip on distribution. I imagine they want to own more of the content to decrease their cost of goods sold and or just have more ownership of the full economic stack and do more creative things. If they own Formula One, like that would be really interesting. Obviously they don't, but like I think there's more things that they can do with their distribution that they're probably going to experiment with.
Is K-pop Demon Hunters still number one?
Not in terms of what's being watched today. Today it's
Oh,
Stranger Things.
Apparently, that one was it was like a Sony production,
That's
but
right.
they
That's
couldn't
right.
get it past Sony to actually produce the thing or something along those lines. So Netflix paid a flat fee to Sony to buy it, and Sony got paid like a flat fee, and then Netflix kept all the upside. What an amazing deal for them.
Amazing deal. But I think we're gonna see YouTube and Netflix kind of like compete more. I really do. I mean, as an anecdote for me, like when I turn on my TV, there's two apps that I open. It's YouTube TV and it's Netflix. Like if I can find it on those two things, then I'll like search it on Roku and like maybe I'll end up in Amazon or maybe I'll end up in Paramount Plus or something. But those are like the Uber and Lyfts for me when I open up my TV.
I mean,
And those
it's
are the two apps I go to.
I think you're absolutely right, and I think I can actually use that as there's different verticals, and there's just true. It's everybody wants to be the one app in fintech. Everybody wants all the services in one. In social or whatever, Uber want all of the services in one. And in media, they want all of your consumption hours. And so it's the
Yeah,
shorts, it's the long forms, it's the podcast. 100%. I think
they
they're
want
all
to
on a collision
they want to
course.
maximize this percentage of TV watch time. And if that means they have to go into new verticals or go into like they're gonna do it. I have no doubts about that.
I agree. It's really about the matter of will they be successful at it, and will Netflix ever be a place where I'll go consume my podcast or whatever.
I bet you watch YouTube original content that's not creator based in the next 2 years. I bet they're gonna have like a Netflix style streaming thing in the next 2 years.
That's a good bet.
That
I
would be
can see
my
that.
bet.
I believe that.
Or maybe even Google tries to acquire like a Paramount or something. Like Paramount is like kind of fledgling. Obviously, they have a bunch of Larry Ellison money, but maybe they try to acquire one of these like smaller streaming players to bootstrap a content list, and then they go from there.
In which of these streaming ones, the question is for you guys, which of these streaming platforms will get the first AI generated for you video first out? It's like you click, you select the topic, you say more show like this, and that's like new original content for you. Which one of them will get there?
YouTube.
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 Yeah.
Yeah.
Yeah,
I mean, they have
probably.
so much of the vertical stacked already,
Yeah.
and it's the brand, right?
But I feel like that like almost needs to happen with an Apple Vision Pro. Like have no like seriously like the form factor of using a Roku remote to like click through like personalized content's kind of freaking weird. Like, do you guys remember the Netflix show? Like, this is probably like 8 years ago, where you could like choose your own adventure.
But actually, I wasn't thinking about it that way. Yeah, it didn't work because it was like an adventure itself. I'm actually thinking about you go to Netflix and you choose content that is available based on your mood. Now you go to Netflix and you tell it, I want to, see a movie about dragons with fantasy mixed in. And I
Oh,
want, I don't
you
know, like
prompt it.
Scarlett
I see.
Johansson to be,
I
you
see. I
prompt it.
see.
And then the movie shows up because it's what you want to watch. So that's, I think, the first thing to go because it is still the form factor that you're used to. It's just like the content is best because it's tailored to you in that moment, not what's available. Everything is available.
Yeah. Do you guys remember Tubi? Do you guys remember Tubi? The like, or not
Oh,
Tubi,
yeah.
Quibi, I think it
Quibi.
Quibi.
was.
Could be.
It was the like short form but high quality content. Uh,
Mhm.
Someone was talking to me, maybe it was last week, about how in Korea there's these 1 minute shorts that you can watch that are like TV episodes, and the first three are free, and then you like get like bought into the story. You have to pay for episodes like five, six, seven, eight. I feel like that might be like to your original point about Sertavo and like discrete forms of content. Like maybe there's more interesting blends of short form and traditional streaming like business models that could be played with as well.
The chart.
Awesome, awesome. Well, that's a wrap. It was great to get together and do another in the charts episode.
See you
It's
guys
good
next
to
week.
hang.
See y'all next time.
See you guys.